Warning: the man who shorted the housing market just bet $1 billion against Palantir. Michael Burry loaded $12.1 million in puts against PLTR. He stacked another $186.6 million against NVIDIA.
You are talking about a massive concentration of capital. That is over $1 billion deployed against just two AI darlings. This is not a hedge. This is a targeted strike on the defining narrative of the decade.
It is the exact same pattern we saw in 2008. He closed Scion Capital after the housing short paid off, and now he has deregistered again. We are going to prove whether the fundamental math actually supports his bet. Look at his last public filing from Q3 2025. Scion Asset Management held exactly 8 positions. The total portfolio size was $1.38 billion. He did not build a diversified fund.
8 positions for $1 billion fund is extreme. That crosses the line from conviction into borderline recklessness. If he is wrong on one position, the entire portfolio implodes. How exactly is he allocating that capital?
80% is locked in 2 massive bearish bets. That is $912.1 million in Palantir puts and $186.6 million in NVIDIA puts.
Let me walk through the structural significance of what Michael Burry is doing right now. The historical pattern here is what actually matters to institutional money.
He made around $100 million personally by shorting the housing market in 2008. He saw the toxic bubble before anyone else even knew what those derivatives were.
Exactly, and remember that after that legendary trade paid off, he closed down Scion Capital entirely. Now I want to look at what he just did in November 2025. He officially terminated Scion Asset Management's SEC registration, which is the exact same pattern. That means no more required 13F filings, letting him trade his massive book completely in the dark.
But he isn't trading in the dark at all, which is the craziest part. He is voluntarily posting his current options positions right on his public Substack. If a guy who famously hates public scrutiny is suddenly broadcasting his short book, what does that actually mean? He clearly wants the institutional market to know exactly where he stands.
That is the critical anomaly we have to sit with for a second. We have to ask if he is building a public narrative like Ackman did with Herbalife, or if he is genuinely issuing a structural warning. Either way, he is pointing a massive flashlight at the artificial intelligence trade, and the size of his specific bet shows he is not just making a casual guess.
The other 20% tells the rest of the story. He bought 6 million call options on Pfizer, 0 tech. He bought 2.5 million calls on Halliburton, plus Molina Healthcare and Lululemon.
So he is buying beaten-down pharma value and old economy names. That is classic Burry contrarian positioning. But shorting the strongest momentum trade in a generation is incredibly dangerous. Is this actual conviction, or is he just playing the contrarian character he built?
You do not deploy $12 million into options premiums to play a character. He sees the exact point where the price detaches from reality. Retail investors think Palantir is an unstoppable AI powerhouse. Burry looks at a $129 share price and says the fundamental value is under 50. I ran the 3-state regime detector on each of Burry's targets. It separates price action into trending, ranging, and crisis states. Over the last 60 sessions, SPY showed 45 trending, 11 ranging, and exactly 4 crisis sessions. That is a perfectly healthy, calm market.
You trained that model on 26 years of SPY and VIX data to find structural breaks. What happened when you ran Palantir through the exact same model? Let me walk through the exact options he bought on Palantir, because this is how institutional conviction is actually priced in the real world. The stock is trading today at $129.09.
Which is absolutely insane when you remember Palantir was a $6 stock back in 2022. It ran all the way to $129 purely on the back of the artificial intelligence narrative.
Burry explicitly stated his belief that the fundamental value of the company is well under $50 a share. and he capitalized the trade to survive a very long period of market irrationality. He holds December 2026 puts at a $100 strike, which currently sit 22% out of the money with 8 months to expiry.
That is a heavy bet for sure, but it is not the main event. What about those massive June 2027 contracts he holds?
The June 2027 puts at a $50 strike are the true structural bet here. They are 61% out of the money and give him 14 full months for his thesis to play out. Think of it like buying fire insurance on a house that is currently standing perfectly intact. You are buying a policy that only pays out if the entire foundation completely collapses to the ground.
A 61% drop is a catastrophic repricing, not just a standard technical correction. What does that specific options timeline say about his actual conviction level? 60 out of 60 sessions registered as crisis, 0 trending and 0 ranging. NVIDIA shows 60 out of 60 sessions in crisis. Oracle shows 60 out of 60 sessions in crisis. The numbers do not lie. Palantir is flashing 58.3% realized volatility.
That is 3 times the volatility of the broad market. SPY is sitting at just 19.8%. But high volatility does not automatically mean the stock is going down. Crisis-level realized volatility does not guarantee a bearish direction.
It guarantees the asset has detached from fundamental reality. The institutions are trading it like a meme coin. The regime detector does not care about Burry's thesis. It reads the tape. And the tape says these stocks are already in crisis-level volatility while the rest of the market sleeps.
Retail investors see a rising chart and think they are perfectly safe. They do not feel the turbulence underneath the hood. But if NVIDIA is churning at 35.2% and Oracle at 39.2%, the structural math is cracking.
The headlines are a week behind the tape. If everyone is comfortable, someone is about to get hurt.
The extreme distance to those strike prices tells us he expects a complete, undeniable unwinding of the artificial intelligence premium. And the broader options market is already starting to wake up to this reality.
The volume we saw today was heavily elevated at over 116 million shares. That is 2.3 times the normal daily average.
That kind of volume spike is incredibly significant and likely driven by massive options flow shifting right under the surface. The institutional money is finally starting to move. Burry's put options are already up 35% since he entered the position in the third quarter of 2025. The market is slowly beginning to agree with his fundamental flaw. While Palantir is the main event, NVIDIA and Oracle show us the actual architecture of Burry's overarching thesis. NVIDIA is currently trading right at $198.
That is a noticeable pullback, already down 9% from its all-time high of $207 back in October 2025.
Burry currently holds heavily out of the money puts at a $115 strike for NVIDIA. He needs a massive 39% drop just to get those specific contracts into the money. But Oracle is his most profitable short so far, as it is currently down 51% from its third quarter 2025 peak. He was completely transparent on his Substack about exactly why he took this position.
You cannot sell volatility you believe in. We have seen this exact setup before. Look at the 2007 parallel. The housing market was obviously overvalued, but everyone was making money.
In 2026, AI stocks are obviously expensive, but the momentum is intoxicating. Everyone is making money on the way up. Burry sees the exact same pattern playing out today.
Being early and being wrong look identical until they do not. He isolates the exact point where the narrative breaks. Then he bets the house against it.
I'm going to challenge you hard on this comparison. The housing collateral in 2007 was entirely synthetic. The underlying debt was toxic. But AI companies are not synthetic CDOs. NVIDIA is pulling in $130 billion annually. They have actual cash flow and real infrastructure deals.
Meta just signed a $35 billion contract with CoreWeave. The market can stay irrational for a very long time. Burry bled capital for years waiting for the 2008 crash. The question is not whether Burry is right. It is whether he is early. He wrote that he absolutely does not like how Oracle is positioned or the specific investments it is currently making. He literally said they did not need to do what they are doing, and suggested it was maybe just ego.
Oracle pushed aggressively into cloud infrastructure and data centers, taking on significant corporate debt to do it. But we have to actively challenge Burry's narrative with the hard data sitting on the other side of the trade.
Exactly, because Meta just signed a massive $35 billion artificial intelligence infrastructure deal with CoreWeave. If the hyperscalers are still spending tens of billions of dollars, how is this whole thing actually a bubble?
That is the exact fundamental tension we need to analyze right now. Meta's massive capital expenditure is not a guarantee of future software profits for companies that built their soaring valuations entirely on hype. Burry is betting heavily that this massive infrastructure build-out is completely disconnected from actual end consumer demand. He is isolating and shorting the companies that took on dangerous debt just to chase the trend. We know what Michael Burry thinks, but as quants, we need to ask what the broader options market is actually pricing in. Palantir's realized volatility is currently running at a massive 58.3% annualized.
That is nearly 3 times the volatility of the SPY at 19.8%. So the tape says Palantir is already trading with violent, crisis-level price swings while the rest of the market sleeps.
That is true, but I want you to remember our first episode on the recent tariff shock. In that scenario, implied volatility on the broad market was actually trading entirely below realized volatility. The options market had collectively decided the tariff volatility spike was transient, so they simply refused to pay up for long-term protection.
So here is the really sharp question for anyone trading this setup. If Palantir is already whipping around at 58.3% realized volatility, what does the options pricing structure tell us about the future?
If implied volatility on Palantir options is trading near or above that 58.3% level, it means put buyers are willingly paying a massive, historic premium. They are structurally pricing in continued aggressive downward turbulence. It means the options market agrees with Burry that the worst is absolutely not over. Let me walk through exactly what we need to monitor this coming week. Watch closely for any open interest changes on Palantir's December 2026 $100 puts. Also, monitor the 3-state detector for the next regime flip on NVIDIA, and carefully read the tape on Oracle's upcoming earnings.
Hit subscribe right now so you do not miss a single market signal. Next week, we are dropping episode 3 on zero DTE backtesting. We ran 10,000 trades through the Quant system to show you exactly